Every year, millions of people try to beat the stock market. Most fail. Yet a small group of investors quietly build enormous wealth, decade after decade, not through luck, but through strategy. Men like Ray Dalio, Peter Lynch, and Benjamin Graham. Their methods created billions of dollars in wealth and shaped modern investing. But the real question is, how do the rich actually invest? And more importantly, what do they know that most people don't? To understand how the rich invest today, we need to go back nearly a century, because the foundation of modern investing was created by one man, Benjamin Graham. Often called the father of value investing, Graham developed a strategy that would later influence some of the most successful investors in history, including Warren Buffett. Graham believed something simple: the stock market is not always rational. Prices rise and fall based on emotion, speculation, and fear. But behind every stock is a real business. And if you can buy that business for less than it is truly worth, you gain what Graham called a margin of safety. His book, The Intelligent Investor, became one of the most influential financial books ever written. And its core message was simple: the rich don't chase stocks, they buy undervalued businesses. Graham's strategy was built on three principles. First, buy stocks below their intrinsic value. Second, ignore short-term market noise. And third, diversify widely. He compared the stock market to a man named Mr. Market. Every day, Mr. Market offers to buy or sell stocks at different prices. Sometimes he's optimistic, sometimes he's depressed. But smart investors don't follow his mood. They take advantage of it. This philosophy would later influence generations of investors. But one of the most successful fund managers in history took Graham's ideas and applied them to a new era. His name was Peter Lynch. During the 1980s, Peter Lynch managed the Magellan Fund at Fidelity Investments. Under his leadership, the fund grew from $18 million to over $14 billion, one of the best performances in investment history. But Lynch's strategy was surprisingly simple. He believed ordinary people had an advantage over Wall Street because they encounter great businesses every day. His famous philosophy was, invest in what you know. If you see a restaurant that's always full, a store with growing customers, or a product everyone is buying, it might be worth researching. Lynch called these 10-baggers. Stocks that could grow 10 times in value. But Lynch didn't just rely on observation. He also studied financial fundamentals, revenue growth, profit margins, debt levels. Because even a great company can be a bad investment if you pay the wrong price. His strategy combined Graham's value principles with growth investing, and it proved incredibly powerful. But another investor approached the market from a completely different angle. A man who focused not just on companies, but on the entire global economy. Ray Dalio founded the hedge fund Bridgewater Associates. Today, it is one of the largest hedge funds in the world. Dalio believed markets were driven by economic cycles, debt cycles, interest rates, inflation, government policy. Instead of focusing only on individual companies, Dalio studied the big picture. He built a strategy called the all-weather portfolio, a portfolio designed to perform in any economic environment, whether the economy is booming or collapsing. The key idea was diversification across asset classes: stocks, bonds, commodities, gold. Because different assets perform well under different conditions. Dalio also emphasized something most investors ignore: risk management. He believed the biggest mistake investors make is concentrating too much money into a single bet. Instead, Dalio focused on balancing risk across the portfolio, a concept known as risk parity. Despite their different strategies, Benjamin Graham, Peter Lynch, and Ray Dalio share something in common. They follow principles that most investors ignore. Principle 1: long-term thinking. They invest for years, sometimes decades, not days. Principle 2: Emotional discipline. They do not panic during market crashes. In fact, many see crashes as opportunities. Principle 3. Deep research. They study businesses, industries, and economic cycles. Investing is not gambling, it's analysis. Principle 4. Risk management. They protect capital first, because surviving market downturns is the key to long-term wealth. The truth is, the rich don't rely on secret tips. They follow timeless principles, buying undervalued businesses, finding companies with strong growth, and building diversified portfolios designed to survive uncertainty. These strategies built the fortunes of investors like Ray Dalio, Peter Lynch, and Benjamin Graham. And while markets will always rise and fall, the fundamentals of successful investing rarely change. The real secret to building wealth in the stock market is not predicting the future. It's understanding the rules that have always worked. Because once you understand how the rich invest, you start to see the market very differently.